Ever feel like the market makes sense until it doesn't? You nail that trade setup, but then all of a sudden everything falls apart. That's because you might be using setups without context, and that's like going into the market with a GPS without signal. So today I'm going to be showing you how to break down and decode the market's language to understand concept a lot better without any indicators whatsoever, from a very simplistic approach of understanding volume and auction logic. And once you see this, you won't be able to unsee it. So we're going to be jumping right into the screens to break down how you can read market context to stay on side and get less confused about market movement from here on out. So let's jump into the screen after the intro, and I'll see you guys there. Remember to like this video, subscribe, and we'll chat soon. Remember to take notes. It's going to be a very important and eye-opening lesson. In this video, we're going to be deep diving into the market context. We're going to be breaking down what market context is, why it matters, how to read auction market theory as well. I'm not going to be using any indicators, no lagging signals, just pure volume analysis mixed with price and logic. So there's going to be some price action in there. I'm going to be covering the breakdown of context naturally, what it means in trading, why it's important. We're going to be talking about compressions and expansions in the market that create market movement and the difference between strong-handed and weak-handed traders. I'm going to be breaking down how balance, fair value, and price discovery do shape market movement, and how all that comes together to be able to read the context of the market, as well as some of the common mistakes that traders make when looking at market context. Why am I using profiles and volume analysis when we talk about market context? It's a very, very simple answer. Market price movement actually is based on volume. So if we understand volume analysis to a T, we can understand market movement from a contextual aspect and even deeper. So let's dive right into this. First and foremost, what is market context and why does it matter? So market context is the story behind price movement. It's the understanding of why there's bullish movement or bearish movement in the market. Market context also breaks down who is participating in the market. Are they defending value? Are they pushing for new territory? Is it strong-handed selling, buying, weak-handed? Everything comes together to get a better understanding to really represent the story of the market movement. Without this lens, even the best trade setups can actually fail, because you're trading tactics without understanding the battlefield. So it's like looking at things from a bird's eye view. Realistically, if you're standing in a field, you can only see so much around you, especially if there's some kind of crops around. But if you're looking at it from an aerial point of view, you're going to see everything and understand, okay, there's the exit, there's a path, there's this, there's that. That's what we're trying to do with volume analysis in the market. So auction market theory and participant behavior allows us to really piece the story together and help us understand what's going on. So to view this a little more, I guess, intently, we're going to be looking at the screen as well. And on the screen here, these are the main two components that we're going to be diving into. Just these two charts that we have. They might seem a little confusing. We'll break them down. But on the right-hand side, we have a volume profile-based chart, which represents the grayed out area over here is a 300 or 400 day cumulative or composite volume profile. Beside it is the last 5 days composite profile, and then each individual session is going to be its own session. So what I mean is the dark background is going to be the RTH, or the regular trading hour session, the New York session for those that may not know, and then you have the Globex session or the ETH session, the extended trading hour session, which combines everything for the overnight, I guess. If you're in an Eastern time zone, is going to be the kind of grayed out background, and each of these sessions is their own individual session with their own volume profile. On the left-hand side here, we have a very simple candlestick chart. It's based on a 3-point range chart, so I'm not really opposed to using time-based candles, but it's not necessarily something that I look at. I'm mainly focused on these range charts. So it doesn't matter what kind of price action chart you have, something that you're comfortable with that's on an intraday basis. Some traders might opt in for a 2-minute, a 5-minute. Those are both okay. So the first thing that we have to understand when we talk about context is that market movement is dependent on fractal components of new information and old information, right? When new information gets stale, markets decide to kind of not move. So this is the concept of compression and expansion. So I'm going to be using a very simple little drawing tool here on the screen to really help us define the compression and expansion of the market. Now, compression, synonymous to general range type market movement. What happens in this area is that price actually just ping-pongs, and it's because no new information happens. Now, these ranges, right, since markets do fractal movement, they can be seen on pretty much any time frame. This kind of compressive period, range period, call it what you will, it happens about 70 to 80% of the time in the market. This is the vast majority realistically, and they accumulate volume, right, and market movement in these areas. This is where we don't get new information. This is where the new information has already been disseminated by the market and buyers and sellers are relatively equal and they create an area that's balanced. So this is how these ranges are created. There's a balance within them. So when we get towards the tops, you know, some of the sellers kind of take over, they get kind of equal in the middle. When we get towards the bottom, some of the buyers take over and then we get, again, equal towards the middle. So these compressive moves are periods like we're seeing today, where no new information is entering the market. It's very neutral. We're holding a general balance. Now, when new information does come out of the market, this is what is called an expansive period. So an expansive period moves outside of these balances and creates these trend movements that happen 20 to 30% of the time. So this is when some new information enters the market, whether it's news-driven, whether it's a tape bomb, whatever the case may be. When there's new information that enters the market, it could also be seen as maybe demand being greater than supply, supply being greater than demand. The buy side aggressive buying is bigger than the selling's bigger than the buying, which creates these expansive moves that move out. These are trend moves, these are trending markets. These two concepts, if we understand just the basics of those and how market participants interact within them, we're going to have a much easier time reading the context of the market. Because what the volume profile does and what volume analysis does, it visually represents these kinds of areas to give us more information of who's in control, buy side or sell side. So like I said, right, we're going to be using the S&P, the ES, the E-mini, as our example here. Both of these charts are based on the E-mini, but we'll be doing some drawing. So until we get to the meat and potatoes of this video, I'm going to leave this part blank. Now, markets, they generally just consistently cycle through periods of balance and imbalance over and over and over again. But what if I told you there's a way to identify this and read this and the anticipated moves that are based on these concepts? So generally speaking, right, if we have a compressive period, this is going to be the majority of the time that the market actually stays within this area, right? It's going to range and it's going to create a balance. It's going to create an area where price is comfortable. At a certain point, there might be some kind of expansion based on new volume and markets move into another compressive zone, or they create a new compressive zone, and then they might move out, they'll go back into the prior one or a new one. And this just repeats over and over again. So just with this simple concept and understanding of volume profile, you're going to have a really heightened understanding of context. But the next thing that we do need to understand when we talk about these things is going to be auction market theory and their participants. So auction market theory, it's the philosophy of how markets move based on auctions or based on volume analysis, right? The market is an auction, meaning that there's constant negotiation of value. It's a two-way auction where buyers and sellers come together to disseminate what the information is to create some kind of fair value, right? There might be fair value way higher based on market participant perception, and the buy side's going to take prices all the way up there, right? There might be fair value lower. So they just go back and forth, exchanging hands to disseminate where the information creates fair value, and then everything outside is going to be unfair value. So price is just the outcome between the battle of buyers and sellers. Market participants, when we talk about market participants, not all traders are going to be equal, right? You have those that move the market and those that follow, right? Those who get beat up. In essence, a lot of people associate with traders that get beat up or follow with retail traders realistically, but that doesn't necessarily have to be the case. Followers can really get a nice piece of the pie if they really understand the contextual market movement, right? They can follow the big players. They can follow the larger movers. So there are two main types of market participants that make up these auctions. You have the weak-handed traders, which are reactive, they're emotional, lower conviction, they're generally short-term, they're generally associated with retail traders. That's not fully the case, but generally we can put them in that category. You also have the strong-handed traders. They're informed traders, right? They're strategic, they're patient, they're longer term, they're usually institutional. They're the ones that create moves, they're the ones that create large size in the market that actually either keeps markets in balance or it moves markets outside of balance. So weak-handed traders, like I said, they're emotional, they generally get trapped, right? They're used as liquidity. They buy highs, they sell lows, right? The classic retail trader, they see a move, they start jumping on it hands first. Strong-handed traders, right, they engineer price movement, right? They build value, they absorb liquidity, and they exploit weak-handed traders, meaning that we should hunt and look for the strong-handed traders and not fall in the trap of the weak-handed traders. Understanding context means recognizing who's, where, and when, right? So how do we do that? We do that by understanding balance and imbalance from a volume analysis perspective. So first and foremost, right, we talked about balance. Balance is an area where the accumulation of the majority of volume comes into the market, right? Balance is an area where is considered a fair value zone, right? This is a range where strong-handed traders accumulate at the extremes of the balance, the tops and the bottoms of the balance, which drive prices within that balance, right? These strong-handed traders are also able to create movement that is outside of balance. So this is realistically a compressive period. Price rotates because buyers and sellers agree that they're generally equal, right? No new information. Imbalance is actually price discovery. So strong-handed traders create imbalanced movements when they overwhelm one side or the other. So for example, if the buy side overwhelms the sell side, the strong-handed buyers are going to allow prices to move outside of this balance. Whereas weak-handed traders, they react to the imbalanced movement and they end up chasing, right? They get long towards the peak where the strong-handed traders say, you know what, I've had enough, back we go. So context isn't just structure, it's the intent and where prices move based on balance that allows us to really understand context. So if we dive into this, we've talked a lot about the theory, but what does that actually look like on a real market chart, right? On real market movement and real-time compression and expansion to understand context. The first thing that we want to look at is going to be a type of composite or cumulative profile realistically. Some kind of composite profile is a profile that takes together the data of multiple days of volume that creates some kind of shape and it creates some kind of balance realistically. So this is where we can identify our compressive periods, our balances, which give us a good starting point. Now, I opt in to use a 200 to 400 day composite cumulative profile. I say a range here because depending on price movement, new price exploration, we might have to increase the size of it because, for example, if we haven't seen an area in, let's say, a year and a half, that we haven't traded within that region, I'm going to have to increase this to get the composite profile from that past data. So from there, right, what we want to do is identify how prices actually move around these areas of balance. But first and foremost, I want to understand where these general areas of balance are on this larger profile. So in some cases, like this case, right down here between this drop-off and this drop-off, we don't really have the clearest of visions of where the actual whole balance is, but something like this is a lot easier to read. Maybe the balance top is somewhere here. So we're looking for areas that have an accumulation of very heavy, high volume nodes that create something that look like a belly. Right? So these are going to be our general balanced areas. We can say this is a general balanced area as well with maybe some kind of stopping points, right, in and around. So These are two general large balances that prices are trying to create right now. Well, I would say this lower one price is trying to create this newer balance that we haven't seen in a while. So when we look at this, we want to note where the extremes are, because that is where we play catch up, right, with the strong-handed trader. So if the extremes are here and here, and then in the higher distribution they're here and here, these are the two extremes where we anticipate strong-handed traders actually getting active. So if we're inside of a balanced area, that tells us that price is expected to hold within that balance, meaning at the tops and the bottoms, the contextual understanding is that strong-handed traders are going to get active to keep prices in there. So when we have movement through different large balances, that gives us a contextual understanding of direction, right? Because rule number one, right, I ask myself, where am I in the market right now? So where am I in the market? Am I inside of a balanced area, right? Am I inside of an area that has a huge volume accumulation? If I am, I have expectancy that price is going to hold this very big range, right? The other possibility is, am I outside of an area like this? Am I in an area that has relatively low volume, maybe over here, down here? The second question I ask myself, right, in terms of context is, how did I actually get there? How did price move into that area? Because that's going to give you the answer of who's generally in control currently in these markets. What I mean by that is, if we have a move that, let's say, holds out within this large balance, and then at a certain point, we move into the other balance from below. In that case, what's going to happen is that we're in a balance area for sure, right? Generally speaking, we would expect prices to hold out in that balance and create this range. But using the second criteria of context understanding, if we've moved from a balance below to a balance above, that means that the strong-handed traders on the buy side were strong enough to move out of an area that has immense heavy volume, which is considered their home, and into another area that has massive volume and can be considered their home as well. Meaning, contextually speaking, we're in a bullish market right now with the expectancy to buy dips into the bottom of the balance. So things might get a little more complicated when we have balances like these where we're a little unsure of what's going on. Because when I draw these balances on the S&P 500, on this 300-400 day profile, I want to make sure that these balances are wide enough so that I'm able to actually have moves and directional context within it. Because if the balances are maybe 10, 15 points apart, it's a little harder to understand that maybe a buyer or a seller is in control. I can use the key drop-offs of these extremes as guideline areas within the general balance to help me understand the contextual aspect of the market a little more, and I can use the individual sessions to give me more context as well. So individual sessions, the main way that they help with context is that we can identify where these individual sessions actually create movement outside of the major balances and where they close their session. So I can use an extended hours trading session and a regular trading hours session to get a contextual understanding, as well as how markets move intraday in and around their balances. So for instance, if I'm looking at these individual days, right, and a combination of this large profile over here, I can get market context very, very easily. So I'm not swayed in terms of a specific bias. So I know that we've moved from areas below back into this general large balance. So theoretically, I am fairly bullish, right? I'm going to be bullish in this market because we're moving from a massive area of volume below, and we've been able to move into a new area higher, which is a very bullish market move. So realistically, this balance is very wide. The bottom band of the balance is 5,900. The top band is approximately 5,985, right? That's an 85-point area on the S&P of balance. So theoretically, as long as 5,900 holds, I can still look for that buy-side momentum, right? I can also look at buy-side momentum at slightly higher prices as long as those areas hold as well. So that's where the individual session profiles come into play. So I can look at the individual session profiles the same way. I don't have to break down where the value areas are, right? Your classic volume profile stuff. I'm just looking at it as to where balances are on individual days and how prices react in and around that area. So if I look at this individual day over here, we have a balance towards the bottom, right? Generally towards the bottom of the larger balance, we have an individual session balance that's being created in terms of a B-shaped profile, right? If you want to know more about shapes and volume profile shapes, we do have a video on YouTube just for that. So we have a balance that's being created at the lows of the major balance. This is a very, very good area for me to continue the general momentum to the long side, right? And just where that overnight balance ends, that's going to be a very key support structure for me to try to get long for the next session. It's the same as this session over here. The general balance was created into the top. Yeah, there was a slight failure into the top, but the bottom band of that balance is my expected continuation to see maybe if we can get the expansion outside of this move into the higher balance. The only way that context shifts realistically is if we lose out on our key extremes of balances. So this could happen on an intraday basis, maybe if we divide this larger area, this larger compressive period into multiple little regions. You can use these little regions here that drop off in volume as guidelines, right? You can use the prior days as guidelines too. So if I know that I have a major balance over here on this day, it aligns with the drop off over here. Right now, I'd want to be bullish as long as that area holds. But the contextual shift here, even though we're within the larger balance, if we lose that, there's very little volume that's keeping this afloat, and we can look at that as a bearish move within the larger balance, right? Until we get towards the bottom of these. But generally speaking, contextual shifts happen when we lose our key balance areas, suggesting that if we lose this large balance, you're looking for a downside move on an intraday basis. We can use these individual sessions to get that same understanding of where we can continue on with the current trend of bullish context versus where it actually collapses. So as long as this area somewhere over here, you can see it on the chart, as long as it holds between 50 and 45, where this key area is where the prior few days of balance are, as long as those areas are still intact, I still want to remain bullish to see if we can actually get the expansion higher through new balances. Otherwise, right, then I might be looking at things that actually turn over and I can get some kind of downside momentum from that. That's going to be the contextual shift. Now, we've gone through a lot from a visual component. We've gone through a lot in terms of examples here. I want to talk about the common mistakes that traders make when reading context. You can always add more criteria, right, to market context to support your thought process. But at a certain point, more isn't better, right? The whole point is to eliminate the need for any real indicators or anything of the sort so we can focus on pure volume analysis and understand context from a market participant standpoint, because those are going to be the traders that actually move markets. So the top 3 mistakes that traders make when reading market context are as follows. Number 1, zooming into the market way too early, meaning tunnel vision, right? Some traders might look at the most immediate price action and they might look at the most immediate incremental moves and start thinking, oh, this is bearish, that's bullish, and take away from the big picture of things. The key here is with the read of market context based on what I'm explaining right now is that I'm looking at things from such a big level that my areas and levels that I want to trade from can be about 20, 15, even 30 points apart here on the S&P 500 futures. So if I look at it from a big picture perspective, I'm able to capture those larger moves where the strong-handed market participants are expected to actually create these extended expansions for the meat of the move rather than trying to tunnel vision in and look at these like little back and forths. So it's a very, very big mistake, and you want to zoom out and understand where the market is in relation to these overall balances. The second big mistake is that traders generally chase price, neglecting either session transitions or context shifts. Traders often fear missing a move, right? Which causes them to jump into things without thinking, what has price done so far? Where am I contextually? Have things changed? Traders get wrapped up in the bias of all of this, right? They might see a move that happened in the morning that's to the downside and think the rest of the day is going to shape up like that when in reality we might have seen a context shift. We might be chugging into a new balance higher, right? We might be contextually bullish the whole day, even though there might have been a sell-off at the beginning of the day. And the last thing that I think is a massively common mistake is that traders overcomplicate things drastically, right? They overcomplicate the understanding of context, they overcomplicate the understanding of trade setups, levels, but in a context perspective, for some reason, we think that the more that we have on the screens, the better it is. Now, you might think that mine's maybe a bit cluttered, but I'm just using one chart here and looking at potentially some price action movement on the tick chart. As I've said before, you want to remove the clutter, you want to break it down so it's simpler to read, understand where we are in the markets and what these markets are doing. There's one little tool that I can add to the understanding of context. We can get rid of this. But there's one little tool that we can add to the understanding of context in general. We can add the idea of price action. So context in terms of balances, volume profiles, right? It's all great. But we can start getting a better feel of who's actually going to hold areas, who's strong, based on price action. The concept of higher highs and higher lows and lower highs, a very simple process realistically. So generally in an uptrend, we want to see higher highs and higher lows. In a downtrend, we want to see lower lows and lower highs. Now, the thing is, from a contextual understanding, I am looking to trade the first tests and first areas of support and resistance realistically, right? So as long as we can move through an area like this, right, this like balance region around 50, yesterday we managed to move through it, that's contextually bullish. I do not want to be short. The only reason for me to short is back under this area. The only reason for me to avoid the longs is if the pullbacks into these areas fail to make higher highs and higher lows, which is not the case. So as long as that's being respected, I can still look at this same area over here as a contextual stronghold for the buy side. Now, if it weren't the case and we come back into this area and we start failing new highs, continuous lower highs, that's going to be something that really ruffles my feathers for a context of that buy side, and there might be a sweep lower. So from a price action perspective, that's pretty much the only thing that I'm going to be concerned with. Is the area I want to sell creating lower lows and lower highs? Is the area that I want to buy creating higher highs and higher lows? So we've gone through a lot here. We've broken down the whole concept of context, how I view it from a volume profile perspective and an auction analysis perspective, based on a very simple chart. Now, you can take this information and you're going to look at the markets from a very, very different standpoint going forward realistically. We've gone through some examples as well. And if you want to simplify your trading, hone your system and your edge, we've got a plethora of YouTube videos based on concepts like these. You can also join us at community.tradeproacademy.com for our open Discord. And the best of all, we do have a free PDF for you guys in the description down below, where traders, they often get sucked into trading demons. They lose their discipline, they build bad habits, and they really, really run away from the creation of an edge by letting these demons overwhelm them and crush their discipline in trading. This is where we'd like to help. And if you want to really, really increase your discipline in trading and help develop your edge, we talk about several loops and demons that show up in trading and how to combat them, creating a trading strategy and edge in a PDF down below. So you guys can go and check that out. And, right, you can build out your understanding of context with that PDF and joining us at TRADEPROacademy.com. So for more videos like these, drop a like, hit that subscribe button, and let me know down below in the comments what you'd like to see, because we're going to be on top of it, and there's more videos like these, especially around volume analysis coming out. So I'll see you guys in the next one.